Hope everyone's having a great day. We want to welcome everybody back to the Blue Sky Business Acquisitions podcast. And yes, we have taken a 6-month break, but boy, we got some exciting news. Tom and I broke off of a main national-wide firm earlier this year and started Blue Sky Business Acquisitions, an advanced exit planning firm. We are an end-to-end wholesale M&A firm. So we're going to help sellers 2 to 5 years prior to selling their business, all the way to listing their business through the process of marketing, diligence, acceptance, and then helping that buyer 1 year post-transaction with your 30, 60, 90. And some of the things that we've done over the last 6 months has become a CEPA. I'm now a certified exit planning advisor, and Tom has become a CBI, which is certified business engineer. Today, we are joined by Joe Thompson with Launch Wealth Management. Joe, thank you so much for joining the podcast today. Tell us a little bit about your background, and then I will launch right into exit planning isn't just an exit strategy, it is just good business strategy, which is our title for today's podcast.
Yeah, well, thanks for having me back, and congrats on the new business. Looking forward to seeing it develop and grow, and congrats on being a CEPA, Matt. I've been in the community now for over a year, so I am the owner and founder of Launch Wealth Management. I've been an advisor for over a decade, and I focus heavily on helping business owners with financial planning and tax management, with a heavy focus on after-tax return for both investment portfolios and business transactions. So really heavy on the tax side and really heavy on the business owner side. So happy to be here and talking about exit planning.
Excellent. Yeah, and thanks so much for joining again. I mean, we had a great episode last year talking about wealth management in the M&A space. And for all the listeners out there, you're able to find us on Apple Podcasts, Spotify, YouTube, along with other platforms. So as we look back at the first half of 2026, the few things we want to kind of touch before we jump into our topics, there's been an increased focus on succession planning among business owners. I mean, number one is the baby boomer market gets older, right? Planning that successful exit has definitely become top of mind. There's a continued seller demand despite economic uncertainty, I think is huge. I mean, all the things that are going on in this country right now between the war in Iran, increased prices. I mean, one thing doesn't change in a business owner's life, and that's time. I mean, every day you get older, right? Plan. But I'm a day older today, and I'll be a day older tomorrow, right? So, for segment one here, we just want to talk about what is proper exit planning, right? Exit planning is the intentional purpose of preparing to exit a business, right? And with our CEPA designations, we try to focus on 3 main areas: business readiness, attractiveness, and personal readiness, right? So what is business readiness? Well, it's focusing in on operational systems, management teams, financial reporting, scalability, risk mitigation, right? Personal readiness is, about life and balance and ownership, identity, family considerations, life goals. I mean, Joe, this is obviously where you live and breathe on a daily basis, right? And then, financial readiness, retirement income needs, wealth diversification, tax planning, estate planning, making that smart move. So we're going to be dumping into a lot of that today. So, business readiness and focusing in on, we'll call it the 4 C's, right? So it's your human, your people, your financial, your systems. We want to take a look at your social. We want to look at all of the things that go into the the unsecured portion of your business. We call those your intangible base. 80% of your business value is going to be built in there. So how do you focus on increasing the operational systems through processes, right? Procedures? Do you have SOPs written? Do you have downline management? And Joe, I think you'll agree when I ask this question. We ask a lot of sellers all the time, if you could take a 6-week vacation today, what does this die?
I think the answer to that, Matt, is usually yes, we have a problem, and many owners can't step away for 6 weeks, let alone 6 months, without having big problems in the business.
No, I agree. When we look at business readiness or business attractiveness, we'll call it, right? Having detached ownership and the ability to take a break is really important, right? If you're an owner and you're directly responsible for 50% of the business, that's usually buyers are going to identify that as a problem. Tom, you focus so much on like buyer interaction. What is the number one thing you hear buyers say when they talk about, the business?
As far as buyers go, I mean, there's a lot of them out there, but only one's going to buy the business. So we ask a lot of questions to buyers, as far as what they're looking for. Are they capable of buying the business? Do they have the liquidity? Do they have a lender lined up? Do they understand working capital? Do they have industry experience? Do they have the character and personality to be able to replace the seller? Is the seller ingrained in the business, right? That's where I think CEPA comes in, as far as setting up the seller, the owner, to limit some of those things, right? Do they have all the contracts with vendors and suppliers? Are they the main salesperson? You know, if that's the case, which a lot of the time it is, can a buyer replace that owner? A lot of times that is a really challenging undertaking. Even if they have the experience, liquidity, a bank pre-qualification, etc. So it's really a marriage at the end of the day between the buyer and seller. We are kind of the dating coaches, so to speak, in the start. And it's difficult, right, to be able to find the perfect match. So, it needs to start earlier. A lot of times, myself, I'm not a CEPA. I'm helping business owners at the time they're ready to sell, and oftentimes they are unprepared when they feel they're ready. Right, the business is unprepared, the owner's unprepared emotionally. The books are unprepared, and it really needs to start 2 to 3 years, ideally. Maybe even earlier than that, as far as thinking about it. I know we'll touch on the dismal D's today, as far as what those are and how they can speed up the timeline that a seller has, right? But coming back to the CEPA designation, I guess you touched on a couple things there, Matt. But like, when an owner says, "I want to sell," what are the main things that we want to understand 3-5 years ahead of time? What do you guys want to see right away? Is it, there's personal readiness, financial readiness, the systems, etc. But within that, how can we help those sellers optimize those categories, so when it comes time to sell, it's easier to find that perfect match?
No, it's a great question. And there's really three things some, business owners going to focus on. One is how attractive is their business on the open market? And when we look at that, we're going to say, okay, is it a recession resilient business, right? Big air quotes there, recession resilient. How dependent is the business on the owner, right? Or do they have handshake agreements? I mean, if the owner is responsible for 50% of the revenue, I don't know how attractive that business is, right? So when we start looking at volatility in the market, are you tied to, global ties. If we get hit with tariffs, how bad does that impact, a company, right? Things like that really identify how attractive is a business, right? And then readiness. Business readiness is, can we exit without a mass exodus of employee base? Can we exit without a mass exodus of customers and vendors, right? If the seller were to remove themselves from the core functionality of the business, does it just all fall apart, right? And, and a lot of times I like to talk with business owners and I say, a business is a lot like a spider web. And at the center is you. But there's very short runs to the next line. Okay. So that means that, do you have direct reports? Do you have a GM? Do you have a plant manager? Do you have a COO? How close is the CFO to your business? Right. And as you go out of the center rungs of that web, right, how much more diversified and strong does the business get? Okay. So the whole idea is that if you have the owner in the middle, and then the next set is way out here, and like we said earlier, six weeks or 6 months, you take the owner out of that, the stable portion of that web falls apart, the whole business would go away. So as a business owner, think of yourself like that spider. You're right in the middle of the web, and you're trying to build this structure to withstand the wind and the environment, right? And that's exactly what we try to do as CEPAs and business advisors, is we want to take a look at, are you attractive and are you ready? But when it all looks at the three legs of the stool, if I don't have a personal readiness conversation with them, the whole thing can fall apart. 75% of all business owners are unhappy with their exit 1 year after the exit. And it could be because they got hit with taxes. It could be that they didn't have enough money. And so often we talk with wealth advisors like Joe, and they're like, "Gosh, I'm working with a client and they just weren't ready. They just weren't ready. They just weren't ready." And why? It's because brokers across the nation, business brokers, bring clients to Joe at the point of readiness, not 2 to 5 years before, so they can have a plan in place. So, and I'm kind of obviously dipping my toe into your pond here, Joe, but I guess, why don't you take a little bit of that and expand on what you see in the market and what it means to you as a CEPA?
Yeah, and I think the personal readiness is something that gets overlooked until it's right before the sale transacts, and that can become a big problem. So when you think of personal readiness, it's like, what does life look like after the sale? And a lot of owners don't put much thought into this. You'll hear people say, I like golf, I'm going to golf. My answer is, can you golf 7 days a week, 12 months out of the year? And do you want to? And I would say 99% of people say, no, I can't. I need other stuff to do. And golf is a filler. It's not a new purpose after your business. So a lot of the owners I work with are very purpose driven, and their identity is tied in their business. And they don't really realize that until that is gone. You're no longer the business owner. Your name is not sponsored on every golf outing and charity and little league team anymore. And that identity that you've indirectly built over the years is going to shift. And a lot of owners aren't ready for that. And that's exactly why the stat that Matt just gave is so accurate, which is 75% of business owners regret selling within 1 year after. So you really have to think, what does my life look like? And what am I retiring to? It's always not what am I retiring from? It's what am I retiring to? And what I hear a lot of clients talking about now is, what does my next chapter look like? And for a lot of people, that's now come into maybe starting another business, helping my kids start a business. And that all ties into deal structure. Do they have non-competes? Are they going into competing sectors? Like, all of this starts to come together. But if they don't have a personal plan, that becomes really challenging and is worth a very deep conversation. And a lot of it starts on the wealth planning side. The other part is it really ties to the financial readiness. The first question I always ask business owners is, have you done a valuation within the last 1 or 2 years? It doesn't have to be a formal, huge valuation, but have you done some type of quantitative analysis to get what your business is worth? Most of the time, the client says, I think it's worth about this much money. And you ask, where did you get that number? And it's, my buddy sold a business similar to my size. Maybe it's a different thing. Maybe it's an entirely different sector. who knows? But this number is generally pulled out of some random anecdotal story they heard from a friend, or from somebody who was trying to get them to sell their business. So for me, you have to come down to what is the business worth? Because without that starting point, you have no idea if this transaction is going to be good for your family and where it's going to lead. If you need 10 million out of the sale and it's worth 7 million after evaluation, we have a really good starting point to say, okay, can we bring in Matt and Tom and start growing the business? How do we get you to 10? It's a much different conversation if we don't do this ahead of time, and it's your business is worth 10, it goes to market, it sells for 7, and now you're in a financially different position and you do not have the right wealth to continue to live your life after retirement. And it becomes a much different problem to have. So I think personal readiness and financial readiness really go together, and it requires planning, 1 to 2 years in advance to really get comfortable with what this should look like for you and your family.
Right. And I mean, that does, prompt the question why exit planning matters, right? I mean, sellers have the potential to leave millions of dollars on the table, right? And as business advisors, as wealth planners, what we want to do is we want to take a look at your business in today's market. We want to look at your best in class, right? And we want to, say, okay, there's a value gap here. Okay. What is the best in class trading for under perfect conditions, and what are you trading for under current conditions, right? And how do you get there? If you're doing 2 million adjusted EBITDA, and that's at 22%, but best in class is trading at 27%, but best in class gets a 5 multiple, and yet at 22%, you only get a 3 multiple. I mean, what happens if you go to 25% on adjusted EBITDA, now you're trading at 4? I mean, if you can add a full turn of EBITDA, that's $2 million. You go up, let's say 2.25. You can add a full turn. We can get you another $2.25 million at the time of close, all by increasing your multiple by 1. So having a 5 or 10 times growth effort there is important. But the unfortunate part is most sellers wait until they're burned out. Most sellers don't focus in on getting a valuation. They don't understand what GAAP accounting is. They don't, they have poor financial records. They struggle with I can do it better instead of creating a team around them, right? Well, the I can do it better people are creating a lifestyle business, and those lifestyle businesses are not worth a lot. But if you want to take that next step and you want to grow your business, that's, step into the value creator shoes. Think about your business as, how do I grow its value? Not necessarily what's in it for me, and I'm going to be the center of attention. How do you put the business at the center, right? And I think that is incredibly important when we think about lifestyle versus value and taking the appropriated steps to make a smart business decision. Good business strategy just starts with good, solid business planning. How many, Tom, over the last 4 years of selling businesses, how many times have we sold a company that actually had a written plan?
I don't know if there was one. I mean, we help them with that, but it's often, a little too late. A lot of times sellers say, I want to sell for X. And they have an idea in their head of what that is or what they think that their business is worth. And we kind of have to set the expectations or, kind of be the bad guys by saying, hey, your business does not support debt service at that valuation, and here's why, right? And I think a lot of times as well, sellers confuse business value with kind of the personal financial readiness. So, Joe, a question for you. How do you help determine whether that number, right, the business valuation number, whether that supports kind of the life they want after the sale?
Yeah, I think that's a great question. It's like sometimes it's chicken or egg discussion. Like you need the business sale, but how much do you need? So for me, it comes back to creating a financial plan and then seeing how much the business has to produce for you to continue living the lifestyle that you want. And then going forward and saying, does the business have the opportunity to sell for what I need now? Do I have time to grow it into what I need? And you can start making sound business decisions. So for me, it really comes down to cash flow planning as to what do you want retirement, I'll use the term retirement loosely, or post-transaction life to look like, and what do you need to get out of it, and then seeing if the business can produce that. To your point, Tom, it's very common that people say, I just want to get 5 million out of this business, but that number is arbitrary and not supported by any type of valuation metric. So you really have to start connecting like reality to the business and showing if this is what you need, like how do we get it there? Or what do we have to adjust in the financial plan to say, this is what it will look like at the end. The other big thing I'm just going to throw out there right now is tax planning is a huge impact on this. Deal structure is a huge impact on this, which we'll get to. But it's like if you say my business will sell for 5 million, you can't just take 5 million and plug it into the financial plan. We have to look at after taxes, after debt repayment, deal structure. Is this installment sale? Did we do a DST? What are we doing with all of this? And then what other tax planning do we have to do after? So building that financial plan in advance really starts to draw attention to the seller that like the list price is not what usually ends up in your pocket. And you have to make sure that after that planning is done, your level of lifestyle that you're expecting is still going to be attainable. And that's done through sound financial planning along the way.
No, 100%. And, I keep coming back to this. Exit planning is simply good business strategy, right? So when you sell a company, it should not just be a transaction event, right? Like it's the next phase of your life, right? It's the next phase of your goal. And even if you're a business owner, you don't sell, right? Let's say you engage a CEPA and you sort of grow in your company. I mean, what does that get you? It gets you increased profitability. You get better operations. You have stronger leadership, right? You have reduced stress, and you get to take a little bit more your time away from the business and focus on those things that really, maybe matter in your personal life. Maybe if you want to spend more time with your kids, your grandkids. Maybe you do want to take those golf trips. Maybe you want to go out into the golf and go fishing, right? Like there's a lot of things that you can do when your company is standalone. And so by bringing it all together puts you into a position of success, plain and simple. Kind of switching gears here. I know we talked about personal readiness and Joe, thanks so much for sharing there. I think the biggest thing, 20 years of doing this, we look back at businesses and they look at it like it is you have your person and you have your business, right? And in reality, it's blended together, right? There's so many, we talk about like brand identity now with the whole social media, stuff, and how do you present your business on the web, and how do you present your person on the web, and I think it really kind of all pulls together, right? So when we look at personal readiness, it's sitting down with Joe and making sure that you have a plan. There's the tax plan's in place, the wealth plan is in place, the estate, maybe the trust plans are in place. But on the business readiness side, we want to make sure that we're taking a look at clean books. We want to look at consistent, even growth, reliable systems, right? I mean, I was on a call with a few weeks ago with someone who was looking to buy a business, and I said, "Why do you want to buy this business?" And their flat out answer was, "They don't have a CRM, they don't track their deals, right? Everything's transaction, and they're not focused on reoccurring revenue." I'm like, "Wow, okay, that's a good company to buy. You got a lot of opportunity there." The problem is just what Tom said. Is that seller said, "Oh, I want to sell my company for this dollar amount," which was twice as much what it was actually worth. And so unfortunately, that deal never came to pass because sellers' expectations were grossly outside what the company was able to support. But I think the biggest things is this for the business owners that are listening to this is, do you have customer concentrations? Do you have like weak bench strength, right? Like if you look at your employees, like there's not a chance they could lead anything. Might want to get new employees, right? Every employee has a seat on the bus, right? And sometimes that seat on the bus is out the back door. But I think, as you're going through, you're a $20 million revenue company and you don't have documented processes, probably something you want to think about, right? If you're a $20 million company and you're the owner and you wear more than one, maybe two hats, might be something you want to start thinking about, right? As I said earlier, Tom, we talked to a lot of our buyers. Business attractiveness is huge in the market these days. What are you seeing when deals go to market as you're going through and looking at all the listings out there? What is the one thing that you notice?
Well, I think three things really sell the business, and that's price, terms, and trust. And the trust factor is huge, right? We were talking about it's a marriage, and you got to be able to trust the owner, the business, to step in and put take a massive risk, right? Take out a SBA loan, for instance, and take over that business. And we're talking about, we're kind of bouncing back between personal readiness, financial readiness, right? A lot of different things. Is the business ready? And that's where the trust is built with the buyer. If the financials and the story of the business don't agree, right? Or there isn't continuity there, then the financials are going to win a lot of times, and that's as an owner or a seller, you're going to suffer from that, which is the reason there's you need to plan, and maybe Joe, if you could touch on the kind of the dismal D's, because a lot of times, well, I'm not ready. I've never thought about selling. Maybe in 5 or 10 years. Well, things can pop up, and you need to be in a position, maybe not to sell necessarily, right? But it doesn't hurt if you're practicing sound business decisions early on. And messy financials, especially, pop up, right? They're going to be found. If not, it's an issue for everyone. But yeah, Joe, if you could touch on kind of those dismal D's and why it's so important to talk about it and be about it, right? And get your team in place now versus later.
Yeah, there's actually surveys that have been done on owners and asking what they think they're going to do with their business and what their exit plan is. And the number one answer was, I'm going to work in my business till I'm unable to do it, either physically or cognitively. And when you hear sellers talking like that, it's like a big wake-up call that says they have done little to no exit planning. The statistic that I think runs the most true is 100% of people are going to exit their business at some point, either on your terms or God's terms, we'll call it. And you can't work till you're dead. And if you do work till you're dead, you are impacting all of the valuation metrics that Matt and Tom both have been talking about. And you likely are going to run into one of the 5 Ds along the way. So the 5 Ds that can ruin your financial planning is going to be death. If you work till you're dead and then you die, your business will be on a fire sale and valuation is going to be drastically impacted. The next one is disability. This comes up way more than you would expect. Owners get disabled, staff gets disabled, something bad happens to owners on the disability side. Divorce. Divorce is one that is common. Clients build businesses. They've been before they were married or after they're married. They have not done financial or liability protection on it. They get divorced, and all of a sudden, ownership and planning around divorce becomes a huge issue, I'll say, to bring up. Owner disagreement. So that's the next D, disagreement. Owners start to disagree on direction, selling timeline. These conversations are challenging. So disagreement can come up. You could have one seller who wants to exit and one who wants to scale up. How do you handle that? And then the last one is distress to the business. So think of market downturns. A key staff person leaves, the building burns down. I mean, there's a million things that can come up. So you have to be planning with the 5 Ds in mind along the way, because just saying I'm going to work until I'm unable to or unwilling to, or the other one you hear is my kids will take over, is not a financial plan. It's not a business strategy, and you have to do more thought than just that.
Well, I think the interesting fact is that 50% of all businesses will sell because of the dismal Ds, right? I mean, stuff happens all the time. And when it does, and you're a business owner, think about what that's impacting, your employees, your customers, your vendors. You have relationships that are impacted if something on that dismal D list happens. But 50%, I mean, I know, Tom, you and I have sold plenty of businesses because the proprietor died, and all of a sudden it falls into the lap of the wife, and the wife's like, I have known nothing about this. What do I do? And all of a sudden now we have a business that would have traded for a 4 times multiple is now trading for a 1.5 times multiple because the key proprietor is no longer in the business. Things happen.
Business I sold was a auto repair shop. The husband passed. Thankfully, his wife who took over, she was an accountant by trade, so she understood, the financial side, but she didn't know how to turn a wrench or do any of that, anything within the business. And thankfully, he had cultivated it was a small team, but really competent, and a team that just carried on until we could find a successor. But things happen, and you want to be prepared for sure. What are some of the things as far as on the financial end, Joe, that an owner should be thinking about? I think one thing that I notice a lot is that they're pulling an income from the business, and just are not sure what life is like, right? Their whole life they've had some sort of income from the business. Maybe they had a salary before they started the business, and now they're pulling an income out. How can a business owner kind of figure out or understand what their financial position looks like, what their income looks like after a sale?
I think that's a great question. And I think that's why my focus has been so heavily on helping business owners, is because business owners are a unique animal, and they are used to different income streams, I'll call it, than what I would say is like a normal W-2 earner. So throughout a lot of their life, they've been piling money back into the business relentlessly. A lot of times it's 80% of their net worth or more. So one asset in their portfolio is 80% of their net worth. And planning around that becomes an important topic So where do we replace the income is one question, but how do we diversify and start to build an investment portfolio following the sale? And I think that really is a point that takes a while for business owners to understand. I've had a lot of business owners say, I don't really trust the stock market. Stocks are boring. Investments are boring. I can get a 8% return in an index fund or 9% return annualized over a long period of time. I was getting 5x on every dollar I was putting back into my business. So having to rewire a lot of the way that business owners are approaching investing and investment strategies following a business sale is a really important discussion to have. And it has to be done early because a lot of business owners just don't have that thought process wired into them. And it's not because it's right or wrong. It's just the asset that's been driving all of their wealth and has created this large amount of money traditionally was all from hard work, reinvesting into their single asset that they understood the most. So getting them to the point where it's like, we now have converted that to liquidated it into a portfolio. What do we do? You have to start reframing the conversation to be, what do we want our legacy to look like? What do we want to start doing beyond the business? And then how do we actually start pulling income from this portfolio? And I think a lot of business owners actually intuitively get this a little better than, say, somebody who worked a corporate job and retired. Because business owners are used to having multiple streams of income. They might have rental properties, they might have, businesses or multiple businesses. So they're kind of used to that lumpier, more inconsistent income. So luckily, I would say a lot of business owners have a good grasp on we just start pulling income out of the portfolio, but the discussion starts becoming very different from how do we do it tax efficiently? How do we pass this money along to children? They're very interested usually in doing charitable giving. So how do we give this money effectively to charities? How do we start doing the legacy planning and what that looks like for kids, grandkids, college planning, you name it. So for me, it's really about shifting their mindset on how do you replace the income they made from the business, but more importantly, what do we do with all of this money and how do we start looking at next generational planning? And I think that's really the focus of the personal side. I would say most business sales are enough funds to cover their lifestyle. So it's less about my business isn't worth it. How do I get there? It's more about I made this money. I worked my butt off for my entire life to get it. I now need to make sure we're preserving it from giving too much to Uncle Sam, bad investment decisions, or just making decisions they're not used to making beyond what do I do with my business every day. So I think it's really about coaching the business owners into what does items are now more important and what does future planning look like. So hopefully that answers the direction you're kind of going with that, Tom.
No, absolutely. I think that's key, right? Like you said, business owners kind of there's a different mentality there. They're used to some of the lumpiness. They're used to different streams of income, or sometimes it's, I want to use words carefully here. It's not manipulating books, but pocketing things. There's certain certain items of value that a business owner can take advantage of that they're not going to once they sell, right? And how do we sort of replace that or make sure that they're comfortable post-sale, right? And so many aspects of that are important, tax-wise, trust, giving, generational wealth. How do you pass it down? If a business owner, let's say they're 3 to 5 years away, but they have done no planning so far, with going through CEPA, is there anything that you guys want to target, within the first 30 days, specifically, to say, all right, here's where we're going to start? Is it sort of a broad, questionnaire? Is it, are there any specific items within that? I mean, does it depend on the industry? Probably a little bit there as well, but you know,
Yeah, it's a good question, right? And I think it's cycle back to each individual business is going to have its needs, right? I think the first thing we'd want to take a look at in any business though is de-risking. You know, you want to take a look at the books. You want to look at all the riskier items that could potentially, cause we'll call heartache in a due diligence scenario, right? So, taking a look at the financials. All right, how clean are your books? Right? Do you use accounting software or are you on a spreadsheet? Right? Do you just handwrite your invoices? Right? So I think de-risking is going to be the number one start for any business owner out there. We want to look at not only their financials, we want to look at their legal, we look at their contracts, we want to look at their customer concentration, their vendor concentrations. I like to say too that you can have an employee concentration issue. I mean, if you got a rock star employee, that's in your business and you consistently are giving them, stuff, how overwhelmed are they, right? Like, are they working 60, 70, 80 hours a week? I mean, burnout is a real thing. And burnout can happen not only on the business owner side, but also the employee side. It can happen on a customer side. Burnout's a real thing. So I think de-risking your business to help kind of set a level playing field is really important. So I think that would be, kind of number one action, right? Number two would be to ask ourselves, what makes this business attractive? Okay, so we've de-risked it, de-risked the business. Now, can we set up reoccurring revenues? Can we talk about diversifying the customer base? Can we look at increasing our margins, right? If we look at like SG&A, and we start looking at our COGS, or do we have lateral movement there where we can increase our profitability? Having an honest conversation with, do you have a scalable business? Can you take it from here to here? If you're just producing just in the state of Wisconsin, can you have the ability to produce on a regional basis, right? Oftentimes you say, well, how do you eat an elephant, right? The obvious answer is, well, one bite at a time. And so if you think, okay, I'm going to service my little town, I service my little community, and then I'm going to service my county, and then I'm going to service my state, and then I'm going to service my region, then I'm going to service, a quarter of the country, and then I'm going to, half the country, et cetera, et cetera. And I think the question you ask yourself is, do I have the ability to do that through the right planning? And I think in a lot of capacity, the answer to that is yes. Just how big are your dreams, right? And then, how much are you willing to risk? Because no matter what you do, business ownership is risky. I think business owners understand that. But growing your business is also risky, right? Diversifying your wellness plan is risky, right? So I think doing this, there's a certain level of risk to it. But I think if you go into it, you de-risk first, and then you set your plan moving forward, you're in a much better spot to feel comfortable with taking on 100 new SKUs, right? Or taking on 100 new clients, or growing and taking on a new widget, or adding a laser or a water jet, or adding a new dump truck. I think when you de-risk, it allows you to expand with less fear, which is, I think really important. The other thing is too, when we look at, uh, initial conversations, I want to look at like the value drivers of that business. What is what's their position in the market? What's their competitive advantages? Right? I mean, Tom, you and I have a listing right now, and it's an online B2B wholesaler. And that is very different from a B2C economic retailer or e-commerce retailer, right? So a B2B online wholesaler connects merchants and manufacturers to resellers, which then those resellers take it and go B2C. There's not very many out there. So you have a really, kind of a lone stallion in the stables, as it would be. It's a really good company. So from a competitive advantage, low market penetration gives you avenue to capture as much market share as you physically need, right? So you're not competing to get there, but putting a management team in place. As I said earlier, is your business is that spider web. How close is your nearest manager? And then the other question is who is that nearest manager? Right? Is that person? Is it your brother? Right? Is it your spouse? Is it your best friend? Who is that person? Right? Because the question of who can also affect the why. Right? Because if a buyer comes in and buys it and they know that your number one confident manager is a closely tied person, that's actually a risk than it is a value, right? Because the loyalties don't lie with the company, they lie with the relationship of persons. So looking at the management team, and then I think the last thing too, I'd want to focus in on how predictable is a business owner's revenue. Can they predict 6 months out? I like companies with contracts and sales orders and pre-bookings. This is one of the beautiful things about like the beauty industry and salons is, people will book their appointment out 6, 8, 9 months in advance. And so you have huge transferable revenue when you sell that business, right? So I think business, that's a very attractive thing. So, and sellers too, I think the one thing we have not talked about here is who the buyer could be, right? Because that a lot of that times, who as a seller, if you want your buyer to be a strategic buyer, you want them to be like more of a financial or an individual buyer. Do you want your buyer to be private equity, right? Is it going to be a family sale from a familial basis? Are you going to sell the company to an employee, right? All of these things play a part in the proper planning of an exit. Because if you're going to sell the company to your brother or your child, there's a good chance you do not get as much for that company as if you sell it to a strategic buyer. So knowing what the purchase gaps are going to look like from a value perspective is equally as important when you're tying this whole thing together, right? Because it could all change on a dime. If Joe determines that your wealth goal is $10 million and we can sell your company for 12 to a strategic, but we can only sell it for 8 to an individual, now there's a deficit there. So a lot of complexities go into this in the first 30 days. But the idea is that you build a strong enough plan that's deployable over the next year. And then you do your check-ins, right? The one thing I love about the CEPA is the relentless execution, right? Accountability among all odds. And, taking on little projects that will achieve a bigger goal. It's huge, right? So,
I like what you said
Joe,
there as far as de-risk, because I think a lot of times you asked me about buyers before, and it's like a lot of times the real buyer is the bank, the buyer,
true, very true.
So if you can de-risk the business, then, and when the credit officer's looking at it, when it's going through underwriting, et cetera, it becomes more financeable and it opens up the fairway quite a bit of who could buy the business. But Joe, I don't know if there's anything you wanted to add to that at all.
Yeah, the two quick comments I'll make are education, I think, is the number one goal for me when I get in front of an owner. Is a lot of times this conversation has never been brought up to them. And a lot of owners are terrified to mention selling, that it's going to get out, the staff will find out. So they look at exit planning as a risk, which is, what if I bring in Matt and Tom and now immediately my whole staff thinks I'm selling, they get scared, they start looking for new jobs. So I think being an advocate for the owner to allow them to plant the seed of like, this is a place where we can talk about it and start strategizing it without having to commit to some large transaction. So it's not like, they're selling in the next 2 minutes or 2 months. If you catch them years in advance, you can morph this conversation over time and spend a lot of time educating them as to why you need to be doing this, the benefits of it, and how to actually do it. It's not, you don't want to be doing this last minute because then everything is a rush. It's kind of like, going to sell your house and all you're doing is painting your trim white, your doors, and saying, good enough, like we'll just go with that. So really for me, I think it's about educating owners as to what their options are. Most people and owners have no idea what their exit options are. There's like 10 different exit options and they think it's sell to my kids or sell to private equity. That's not true. Matt touched on a few earlier. So educating them and knowing what that means. And then the other part is, I think, leading my call to action on them would be start building your team early. And what I mean by that is you want to have Matts and Toms and Joes in the room, but you might have to swap your accountant. They might not be the right fit going forward. You might need to kind of polish up the bookkeeping, and no offense, but your sister-in-law who just runs her QuickBooks part-time might not be enough. You might need to have somebody refresh the books and upscale it and adjust it. So I would say your team is very important in this process, and you need people who have done the reps and been through it, because my guess is a lot of the key players that you think are going to help you now as you get closer into the exit phase are going to have to be added to or adjusted. So I would say being open-minded about reviewing your team and making sure you have the right people giving you this guidance.
I've said this for years, that small teams win deals. And that is 100% the truth, right? I think the biggest thing, and what might make sense to the folks listening, is, you go to your family doctor every year for an annual checkup, right? Your doctor is your buddy, right? They know everything about you. They go golfing with you, and all of a sudden you have a heart issue and you need to have heart surgery. Is your family doctor going to be the one in the room cracking your chest open? Or are you going to be there with the cardiothoracic surgeon, right, who has done this 1,000 times, knows exactly what to do, while your doctor advises and assists, right? So bringing the right practitioners in is really important. But having a key quarterback in your life that understands your goals is equally as important. And that's why I said small teams win deals. If you bring people around you that share in your goal and help you achieve, all they're doing is bringing value. All they're doing is making your life better, growing the company, increasing your profitability, reducing your stress, putting you on a path to making a smart decision later on, whether it be at will or forced. Like we said, 50% of all businesses will exit due to the dismal Ds. And you do not want to be the one that works until they're 80, passes away, and then the company, falls into an estate and just kind of falls apart, right? So we covered a lot here. And, Joe, I would love for you to kind of, finish out here with an educational segment, a little bit about wealth, what you do, and really get granular for the listeners. And then I'll wrap up with our final thoughts and introduction to next month.
Yeah. So I really structured my firm around business owners, exit planning, and tax planning. So as Matt talked about, I'm a certified exit planning advisor. I'm an IRS enrolled agent. So the only credential for tax advisors issued by the IRS. So for me, it comes down to being highly focused and highly specialized in doing planning around acquisitions and exits for owners. I think business owners have a unique approach to financial planning, and they need somebody who understands the process. And being a CEPA and EA is really what is that specialization in knowledge on how to advise these more complex situations. We always start with what are your goals and just hearing what you're trying to achieve. For me, money is the tool. It is not the end result. And I think most people think that way. So it's having a conversation to say, where are you now? Where do you want to go? And how do we get there? By being the most smart from a risk stance, from a estate planning stance, from a tax planning stance. Nothing is cookie cutter. There is no models in my world. So it's really, what do you want to achieve and how do we do it? So I think that's really the focus that I try to take with my clients and do it all from a highly educational standpoint. So not just what are we doing, but why are we doing it? I think a lot of my clients really find the value in understanding the plan, not just getting told you should do this or that. So it's really about education as to what you're doing. And then eventually, a lot of it is getting next generation involved. How do we get this to my kids? Can you help my kids? What happens when they get this money? A lot of people overlook stewardship of inheritance. It's just my kids will just get this money. Well, a lot of the clients that I deal with want to instill some type of values or thoughts into this money. Like, this is how we should think about charity. This is really my intent with this money. And you can start to cultivate a much better family relationship around the money, what we want to achieve, and how the family should be thinking about next generational planning. So that's my quick level spiel. The other overflow I always say is, for me, tax planning is an overlay. It is not an add-on. A lot of wealth managers say, I work with business owners. And my next question is, what does that mean? And 9 out of 10 of the times I hear, once they sell their business, I invest the money. So my comeback is always, so you work with ex-business owners. You don't work with business owners. Really, this process starts well before the sale, just like we've been talking about this whole time. You need somebody who understands this process and is on the journey with you, and not just at the end of it after the sale wire hits your check, or your checkbook. So really, it's about long-term planning with somebody who understands business ownership. And I think that's really where I target helping clients.
Excellent. Joe, thanks so much for joining today. Thanks so much, for sharing. And obviously it's a pleasure working with you. For all the listeners out there, we'll definitely be sharing Joe's contact information. So if you got questions, call, text, email, I would assume, right, Joe?
Fire away. Yeah, happy to do it. And thanks for having me.
Love it. All right. Well, guys, as we wrap up here, just a couple of final thoughts for you. Exit planning starts years before a transaction. Exit planning is just good business strategy. You have to have it. It's good business planning, right? You need to, as a business owner, you need to have, 3 legs: personal, business, and financial. You got to bring all 3 of those together. Your business is built for value, right? Not for individual earnings. And the earlier you start, the more options that you create. Final question for the listeners out there. If a buyer were to approach you tomorrow, would your business be ready? And would you be ready? I think that is a really good question to ask yourself. Blue Sky Business Acquisitions Podcast is available on Apple Podcasts, Spotify, YouTube, and other various social media platforms. We really appreciate you guys taking the time today. Like, follow, and subscribe for future business advice and CEPA certification designations.